Welcome to JPMorgan's fourth quarter earnings call. Here's Jamie Dimon. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks rallied on Wednesday as high hopes for bank earnings paid off and a crucial consumer inflation update showed key prices increase less than expected in December. And it was an everything rally. The Magnificent Seven roared. Microsoft, Google, Meta, Nvidia, Apple, all in excess of 1%, particularly Meta after some of the news we got with regards to what's happening with TikTok. They are not selling to a US subsidiary. Tech, software, semiconductors rallied, and we also saw a broad-based rally in stuff like retail, utilities, energy. The only lackluster sector here today was kind of healthcare as well as staples. They were the only two sectors that were somewhat flat in the green, but the real winners today were banks, finance, as well as credit services right here. Banks were extremely green across the board, particularly the money center banks. Look at Berkshire, JPMorgan, Blackstone, American Express, Wells Fargo, Morgan Stanley, Bank of America. Some of them reported today, others didn't, but some of the standouts were stuff like BlackRock, Citigroup, Goldman Sachs. They were all up in excess of 5%. If we look at credit services, stuff like Visa, which is in my portfolio, PayPal, these two stocks make up 40% of my portfolio, both up in excess of 2.5% and 3.25%. Very, very strong day across the board. And it wasn't just the S&P 500. Large caps, mid caps, small caps, they all did really, really well, particularly small caps with regional banks. The entire sector up in excess of 1.25%. Look at small cap growth, small cap value. But the real winner here today was also just the large cap stocks. So, when the market's going to rally on the back of the CPI and banks are actually going to do really well, but not as much as some of these large cap names, Nvidia, Meta, etc. Large cap growth was up 2.75%. Absolutely crazy, but a solid bullish day across the board. And not just in America, we actually saw Europe was very positive. Same here with Asia, South America too. And that's because most of the rest of the world are heavily weighted to financials. Europe's stock market is really just like financials and industrials. Here in Australia, it's red, but our stock market is really just financials and resources. In Asia, it's really just like financials and tech. So that is why we're seeing globally markets rally on the back of the bank earnings as well as the CPI report. And that was really it today. It was a double whammy of good data. We got a really positive CPI inflation report, and then bank earnings lit the fire underneath the market. And it was very simple, guys. US inflation rose to 2.9% in December, matching expectations. However, when you look at core, which is what the Fed look at, core inflation fell to 3.2%, which is below expectations of 3.3%. And guys, like I've been saying on this channel for a while now, shelter inflation or shelter disinflation is going to play a big role in the overall inflation picture over the next year. And that is why I think we're going to see inflation really move lower in a material way this year. And we are actually going to get more than 2 rate cuts. Shelter inflation is going to give the Fed the power to cut the rates they need. Because when you look at shelter inflation, right, very, very elevated relative to overall inflation. But if you just simply remove the shelter inflation component, you look at all of the other components, right, food, energy, the works, we're sitting at the Fed's target. So pretty much what this means is that shelter inflation or shelter is the only reason why we're seeing this elevated level of overall inflation here today. So in other words, guys, as we continue to see shelter disinflate, and there's some very material stats going around showing that we are seeing material shelter disinflation, and in a lot of states, deflation, that's really going to help the inflation picture. And I think the market is starting to figure that out right now. I've been ahead of the curve for the past couple of weeks, and that is why I think we're going to get a lot more than 2 rate cuts this year, but it's going to be back end loaded, very similar to what we had in 2024. Now, this was one piece of the pie. The other piece was the banks. JPMorgan and a whole bunch of other banks released their earnings. JPMorgan was up 2.4% after it recorded record yearly profits. Its fourth quarter profits were up 50% on a year-over-year basis. Absolutely insane. Their investment banking revenue was up 49% from a year earlier. Trading revenue also increased 21%. And Jamie Dimon came out and said the US economy has been resilient, unemployment remains relatively low, consumer spending stayed healthy, including during the holiday season. That means Q4 earnings probably will continue to stretch into other parts of the market. This is very, very positive. Goldman Sachs beat Wall Street's estimates. It earned its biggest quarterly profit in more than 3 years as the investment banker brought in more deal fees while its traders benefited from the active markets. Goldman was up nearly 6% in today's trade. Investment banking fees rose 24%. Equity and debt underwriting revenue jumped 98% and 51% respectively. Across the global industry, investment banking revenue increased 26%. However, advisory revenue did decline by 4%. And the CEO came out and said there has been a meaningful shift in CEO confidence, particularly following the results of the US election. Additionally, there is a significant backlog from sponsors and an overall increased appetite for deal making, and this is supported by a improving regulatory backdrop. Very positive stuff. And then we also had BlackRock reported earnings. They were up 5% here on the day. BlackRock attracted an annual record of $641 billion in client cash. They now manage $11.6 trillion in assets. This is such a huge firm. The $641 billion in client cash that they brought in the past year included $390 billion in ETF flows, 226 into equity funds, 164 billion into fixed income. And Larry Fink came out and said this is just the beginning. BlackRock enters 2025 with more growth and upside potential than ever. Good guidance. This is why the stock was up 5%, and probably in their next earnings, expect BlackRock and Larry Fink to probably split this stock. It's trading at $1,000. They're probably going to do a 5-to-1 or 10-for-1 split. And for everything we saw here, guys, market momentum and market breadth was very positive. We had 4,800 advances, 1,300 decliners. This is absolutely huge, a large shift compared to what we've seen in the last couple of weeks. And when you look at market momentum, things really started to turn. We regained these longer term moving averages, both the 150-day and the 200-day after today's trade. And we also saw a huge uptick in the 5-day, and we also regained the 20-day moving average. So from here, we want to go ahead, retake the 50-day, retake the 100-day, but the long-term moving averages look very, very solid. The shorter-term noisy averages look very, very solid. Once we retake these medium terms, we can then go back to regularly scheduled programming, which is buying dips, selling rips, and equities simply moving higher. Let's hop on the charts. Now, on the back of the better than expected CPI report, we saw yields across the curve move lower. The 2-year, 10-year, and 30-year yield all came off their highs in a very significant way. We saw the dollar as well come off its highs, but inconsequential, really down only 0.11%. Bonds gained as a result, and the positive correlation between equity and bonds continue. But the place you really wanted to be today was equities. The S&P 500, the Nasdaq 100, large caps, small caps. Look at the RSP, look at mid caps, all gained in excess of 1%. And in some cases, the Nasdaq 100 up 2.48%, the S&P 500 up 1.93%. And that is simply, when you get the double whammy of earnings and that cool inflation print, what you really get is what you're going to see today. And that is super positive for markets. Lower inflation, better than expected earnings. It's like Goldilocks. It's a double whammy. It's exactly what you want. Yields came down. The dollar retreated. We also saw very positive momentum here in commodities, as well as crude and nat gas. WTI were up 4%. And that's because inventories fell for the 8th straight week. but silver was up 2.84%, gold gained 0.7%, and Bitcoin gained 3.4%. And all in all, when you actually look at the market momentum, guys, we did something I've been saying that we really would be doing if we got a cool CPI print, and that's retaking the gamma flip. I always said to buy here, guys, and look at what happened. We've retaken the gamma flip zone in a very, very strong candle. That is a bullish candle. It's a gap up and go. We gapped up right into positive gamma, and we just saw very steady price action throughout the day. If we hop on the one-day chart of the S&P 500, you could see after the gap up right here, yes, we did make a high, but we actually did go ahead and retake that high, and we just made higher highs, higher lows into the high of the day with the S&P 500 just shy of a 2% return. And then what does that mean? We probably go and trade and attack the 6,000 level now for the S&P 500. We might have a minor pullback, some consolidation here into earnings for the rest of the week, but do expect us to go ahead and retake the 6,000 level. And even if we do pull back to this gamma flip zone, this will likely hold as support for us to continue higher. We have earnings and inflation tailwinds with the market. We probably go, and this is very likely the bottom. Risks do remain if we go ahead and break the gamma flip, but some exogenous event is going to have to go out there. And we know that's probably not going to be the Trump administration. That's already all been discounted into the price. We have inflation cooling, earnings around the corner. Earnings look to be very, very strong. This is exactly the market you want to be long in. And we probably continue the same move we've seen in 2023, although not to the same extent, where equities probably do move higher, but not without some volatility. Looking at the Nasdaq 100, very similar situation. We've retaken the gamma flip. So if we do pull back, consolidate here, that will be positive and then make the next move higher. But ultimately in positive gamma, we are now targeting the 21,680 level into January OPEX. Looking at the RTY, very solid, up 2%, actually outperforming the S&P 500. Now we are about 10 minutes away from the close. A big wick nonetheless. A big wick off the highs right here. That is on the back of regional banks. However, the RTY is higher beta, so you are going to get more volatility. And yeah, this is really looking like the low. In yesterday's video, I said this looks like the capitulation, the flush. That's exactly what that was. We're in positive gamma. We actually nearly hit the core resistance at the top end right here. We did pull back. Let's aim for 2300. And if we see the core resistance moving up in any of these indices, that's probably very, very good. I think we should see the Nasdaq 100 and the S&P 500 core resistance move higher. The closer we get, we may actually see a move higher in the RTY's core resistance tomorrow. Nonetheless, guys, looking at the broader market, the RSP, this looks like the most constructed, even though it was one of the underperformers year today, still up 1%, but it did break these key levels. That probably means we go onward and upward from here. We're probably going to go for the 180 level and maybe 182 for the RSP. So I would say that we need to consolidate at this area right here where we actually put in the open of the day. So right here, that is the level you want to stay above in the RSP. If we stay above that, we can have a pullback consolidation right here. We stay above it though, Bob's your uncle, and we probably move higher in the RSP. Guys, everything looks very, very constructive. Look at Bitcoin. It's actually trading here at the 100,000 level. I would say that if you're a Bitcoin bull, you probably buy this right here in the mid 90,000s. You buy that, you probably go and see maybe 110 sometime. I do think we probably go and see at least the highs, which is near the 108 to 107 level in Bitcoin. The 1 year chart of Bitcoin looks very constructive. We have a rally, then we have some consolidation, then we have a rally, and now we just got a next consolidation. Probably means we go up and rally again until we see some exogenous event pulls us out of the sky. Bitcoin probably does move high, and that is the case with equities. The path of least resistance is high, guys. Now, stocks that I personally am buying, individual names, you know, the ETFs I like, the S&P 500, the Nasdaq 100, Moat, small cap quality. Looking at Evolution. Now, this is a stock that hasn't performed that well in the last year. Nonetheless, Evolution is up 1.75% today, and I think this is great value trading at 13 times forward. So if you're looking for value in an undervalued market, look at Evolution. The stock probably grows 15% this year. And there's just a lot of sentiment concerns. That's why we've seen it move down. It's a bit of a contrarian play. Another name I like, another name I'm in. You guys know this. I've been bullish on PayPal since the $50 level, and we're at $90 right now. I think we see triple digits. We tried to put in a low right here. We did actually make a lower low relative to this low. However, we've retaken these highs, and I think we go see 93, 94, 95 sometime into its earnings, and earnings will be the next deciding factor. Another name I do like is Google, guys. If you want to have exposure to the mega caps, this is what you want. Now, Google is sort of forming this base right here, and then you want to see the next move likely going higher. I think Google is undervalued. My fair value is 220 for Google. All in all, I like all of these names. That's where I want to be positioned. I've been indexing as well, guys. And if you just want to ride the wave, buy something like the S&P 600, right? Look at these mid caps, S&P 600, S&P 400, and they will do very well in these two ETFs. Nonetheless, guys, we're in positive gamma, and that means we buy dips, sell rips, target the core resistance, and that's the 6,025 level for the S&P 500. That's the 21,680 level for the Nasdaq 100 for the RTY, and that's the 2,300 level. Everything is shaping up exactly as I've said over the past couple of weeks. By waiting for a Q1 dip, it looks like we've got it. We just need follow through and the options market to give us the firepower in terms of the core resistance and gamma flip zones moving higher for us to go out and maybe retake some of the highs we've seen in these indices. In other news, guys, if you're long equities, hold. And any dips we do get, buy those dips. Things are shaping up very well for 2025. And guys, let's talk about sentiment. This is the Fear and Greed Index, something we've been looking at a lot lately to gauge sentiment, and we continue to trend right here in this fear zone. We still haven't really moved from where we were at the start of this week, which is right here on the edge of fear and extreme fear. And again, guys, like I've been saying for the past couple of videos, when you get to this part here in the Fear and Greed Index, this right is the buy zone. This is exactly what this indicator is meant to say right here. Okay, this is meant to say buy. And on this side right here, this is pretty much meant to say sell. Look at where we are right now. We are nearly in the buy zone. And as investors, you should really be taking the opportunities that we do get in these dips, especially when the market believes that we are still probably going to get 2 rate cuts this year. Now, I asked you guys on the weekend poll, how many rate cuts will we get in 2025? The winner was 2 rate cuts. In second place was 1 rate cut. And for all intents and purposes, 75% of the 812 of you guys who voted believe we will get between 1 to 3 rate cuts in 2025, with only 25% of you saying none. So if we take this as a parameter for the entire market, we probably do get rate cuts, and in an easing cycle and when earnings are growing, you wanna hold equities because margins expand, earnings grow, and equities do very well in that type of environment. And in Q4 earnings, what we are about to enter, we are expected to see 9.6% growth in the S&P 500, nearly double-digit growth. If we beat ever so slightly, we should see double-digit, maybe 10%, with the majority of growth coming from the comm services sector as well as the financial sector. Tech now in third place, discretionary and healthcare also double-digit growth, 12%. Real estate too, guys. Look at this. This is 1, 2, 3, 4, 5, 6 of the 11 major sectors seeing double-digit growth. And really what's weighing down the overall growth in the S&P 500 is energy. They're seeing a decline of negative 27.1% here in Q4. Absolutely brutal. And guys, like I said, when we get rate cuts, when earnings are growing, margins tend to expand, stocks do very well in that type of environment. But if you don't want to hold US equities because valuations are very high, US equities currently trade at about 22 times, you can look at almost every other market. They are all trading at a discount relative to the S&P 500, from Europe to Australia to Japan, China, Asia, and even emerging markets. They are all trading at a relative discount. And so if you are looking for value, look outside of the US, but you also definitely do want to hold large cap stocks because look at this: comm services, financials, tech. These are the growers this earnings season, and these will continue to be the growers in 2025 as well as 2026 earnings. You definitely want exposure to US large cap. All I'm saying is if you're looking for value, look at these geographies and these sectors respectively. Now, with US valuations at an incredible 22 times, yes, that is pricey relative to history, and generally speaking, the probability of a 10% correction at any point over the course of the year, when valuations are as high as they are right now is 80%. So it's very likely we are going to get a 10% correction this year or more. In fact, you can see where valuations are right now. Generally, you can expect about a 15% drawdown about half the time. So there's a 50-50 chance we get a 15% drawdown. It's actually a 30% chance, guys, that we actually get a 20% drawdown. So yes, do expect stocks to go higher this year, but not without some volatility, guys. That is the price we pay for outsized returns in the market. And you do want to take advantages of those dips if we do get them. Because like I said, when earnings are growing, margins are expanding, stocks tend to move from the bottom left to the top right in the chart. However, it's not as linear as this right here. It looks more like this right here, very choppy, but net, we will move higher, especially if the macro holds up. And guys, I have some charts for you right here. And the bottom line is the economy is strong. Look at daily data for restaurant bookings at some of the highest levels ever going back to 2020. Weekly bankruptcy filings at some of the lowest levels we've ever seen going back to 2006. Weekly business formations reaching cyclical highs. You love to see that. Household debt to asset ratios at 50-year lows. And this is on the back of exceptional performance in the US financial markets and the continued rise in US house prices. You love to see that. And at the end of the day, guys, whether you're in the US or any other market, there is a record low share of countries expected to be in recession in 2025 and 2026. And all of this is conducive for equities to rally and move higher in all geographies, and with the US market to be the center of outperformance among all of these. Guys, now let's talk about earnings. We got past the big mega banks and it continues tomorrow. TSMC reports before the open, United Health, Bank of America, Morgan Stanley, US Bancorp. We kind of know how these banks are going to report based on what we saw here today. Infosys is also reporting, as well as PNC, M&T Bank, and then that's really it. And we have a couple of names here on Friday, but we'll tackle that in tomorrow's video. For the rest of the week, data is kind of tame. We just really have retail sales, building permits, housing starts. The big data is obviously behind us. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.